I'm Sebastian St. James. Insurance is fundamentally flawed. Each year you pay your insurance premiums to a range of different companies. They say, thank you very much. Now make sure you don't claim. Goodbye. See you next year. So, what actually happens if you do make an insurance claim? There is no set amount of home insurance claims you can file. However, 2 claims in a 5-year period can cause your home insurance premiums to rise. Over 2 claims in the same period may affect your ability to find coverage and even lead to cancelled policy. Cancelled insurance policy? How does that work? This is where your insurance company says, I know that you've been faithfully paying your premiums for the last 10 years and you've never claimed. However, this year you've claimed twice, therefore we're cutting you off and we refuse to have anything more to do with you. Your policy is now officially cancelled. Does that remind you of anybody? Well, to me, absolutely it does. Here are the top reasons why makers limit accounts. This is YouTube, so we'll skip over certain words. You win too much. If you end up winning too much, there is a high likelihood that your account will be limited or even potentially closed. While this may not be obvious to you, this is in fact the most popular reasons why accounts are limited or closed by sports. It's obviously great if you're winning too much, as that means you're making money. However, it's not great if that ends up limiting or closing your account. At the end of the day, sports are in business to make a profit. Sports don't mind clients winning here and there. However, if you end up winning more often than not, that means sports is losing money on you and they don't like it. While it may not seem fair that they can limit or close your account because you win too much, it is within their right to do this. Well, that doesn't seem fair, but that is how it works in practice. How does this work with insurance? Your homeowner's insurance is there to protect you, but what if you file too many claims and the company refuses to cover you anymore? Also, how do you know how many claims is too many? They say, we don't care whether you've had a run of bad luck or not. We're not insuring you anymore, said Terry Foote. After filing his 5th claim in 37 years, State Farm, which is an American insurance company, let Foote know that they would no longer provide homeowners insurance for him. Foote is in temporary housing because his house caught on fire and is being repaired. That's what I pay insurance for, Foote said. He used to pay State Farm $891 a year for homeowners insurance. Now he said the best deal he can find is USAA for $4,300 a year. Wow, that is a massive jump up. It should not just be a numbers game, and that's what it is, Foote said. Insurance, sports company, awfully similar in their behaviour, isn't it? You win too much, you claim too much, you get cut off. So here are the insurance truths. Insurance is like sports. Claim or win too much and your account will be closed. Oh, this is Ideal Insurance. Who is Ideal Insurance? What is their slogan? Happy to help. That's rather nice of them. Oh, here is their app. Yes, looks very nice. With Ideal Insurance, claims will never cause your future premiums to go up. This is amazing. Multiple claims are just fine. And I'm just fine with that. With typical insurance, your claims will always cause future premiums to go up. It's just a sad fact of life. And claim too often and you'll become uninsurable. Wow, that is a risk on a product that is designed to protect you from risk. But the insurance company is protecting themselves from you. The nice thing about having insurance is the peace of mind that if something goes wrong, I'm always covered. No, that's simply not true at all. With typical insurance, the claim rejection rates are from 7 to 37%. Who is going to protect you from the insurance company? Up to 37% rejected claims. ASIC provided an example of rejection rates on TPD cover. Here, Company A rejected 37% of claims. Who is Company A? That we discussed more in the previous video, but up to 37% of claims are being rejected. However, with Ideal Insurance, claim rejection rate 0% on genuine claims. I need to know more. With typical insurance, claims can be rejected for disclosure errors. When you sign up for an insurance policy, say on the internet, they will ask you a series of questions. Some of them are easy. What is your name? What is your address? Some of them, not so much. With house insurance, are your tiles on your house right now concrete? Are they slate? Are they tile? And if it's a metal roof, is it actually colour bond, or is it tin, or is it something else? You need to know, because if you select the wrong option, then you're actually not disclosing to the insurance company truthfully. So your walls, are they brick? Are they double brick? Do you know what the difference is? Are your walls weatherboard, or is it hardy plank, or is it vinyl cladding? Do you know the difference? In approximately what year was your home built? How am I supposed to know this? If you've just moved into a house you've built yourself, you will know this for sure. But if you bought a second-hand house, maybe it was built sometime in the 70s, I don't know. I have no idea. Well, you need to know, because if you do not disclose this information that you're required to know, then possibly that could affect your future insurance claims. You have a duty of disclosure. If your car is modified from the manufacturer's original design and your insurer is not made aware of it, your claim for damages could be refused. So, bog standard car directly from the lot is what you need to go for, else you need to disclose it. These are some of the questions I've actually been asked personally when I've signed up for insurance policies. The number of areas in square metres of your bedrooms, the area of your verandas in square metres, the distance from the nearest tree taller than 2 metres. That's a lot of information, and information you probably will not know off the top of your head, but you have a duty to disclose it accurately. With ideal insurance, however, claims are never rejected by disclosure mistakes. Okay. With typical insurance, claims can be rejected for items not covered. In other words, loopholes. Here's one, named driver. Here's an example. Your brother flies in from interstate and is staying in your house for a few days. He says, I'll run down to the supermarket and get you some milk. I see that you're out of it. Where are your car keys? On the way to the supermarket, he has a little accident. What will happen? Named driver. You may not be covered if the person driving at the time of the accident is not listed on the certificate of insurance. Depending on the insurance policy, if your brother wipes out your car, obviously his name is not listed on your policy, he doesn't live with you normally. Too bad, you get nothing back from your insurance. Breaking the law. Car insurance will not cover you if you have an accident when you're carrying more passengers than you are legally allowed to. It doesn't cover you if your car is taken away because it's illegally parked, or if you receive fines for speeding. When you had your collision, were you doing anything that can possibly be construed as illegal? Were you going 5Ks over the speed limit? Were you talking on your cell phone? Anything at all could potentially get your insurance policy cancelled, and no, they won't pay out a cent. Of course, you've hit the other driver. If you're at fault, you may have to be out of pocket personally for that. Driving against medical advice. You won't be covered if you have an accident while driving when you're instructed to do so by a medical practitioner. Maybe you've just been given some strong painkillers by the doctor. He says don't drive for 48 hours, but basically you feel fine. And again, you've run out of milk. You're always running out of milk. What's wrong with you? You jump in your car, you feel okay, but you have an accident. Of course, you're driving against medical advice, and therefore, no claims for you. Non-standard accessories. Simply not all modifications are automatically covered. If you have an expensive sound system or metallic paint. Metallic paint is almost standard for some cars, and yet it's not covered unless you mention it. Stolen property inside a vehicle. Don't assume everything that's stolen in your car will be covered by insurance. Certainly if you left the car unlocked and then items were stolen, you won't be covered. Oh, I'll never leave my car unlocked then. Ideal insurance. If you've got a policy, then you're always covered. Here is an American list of insurance companies that's showing for every dollar that you pay in insurance, you get back around about 50%, give or take, in insurance claims. So, with typical insurance, you get back around about 50 cents on the dollar of your premiums. With ideal insurance, you can claim back 100% of your premiums. At this point, you're probably shouting at the screen, I do not want typical insurance. I want ideal insurance. Where do I sign? So, what is ideal insurance? How does it work? Who's it suited to? Who is it not suited to? What's the best way of implementing it? Ideal insurance gives you an option. It's something for you to consider. It is not financial advice. Step number 1, decide what type of insurance you want to cover. Step number 2, get a quote from a typical insurance company for a policy. Step number 3, pay that policy premium into a dedicated account that you own that is only used for insurance. Step number 4, invest your premiums into a broad-based cheap index fund like an S&P 500 ETF. With typical insurance, you lose 50% of your money. That's the premiums that you pay in. With self-insurance, you lose 0% of your money because it's your money. Although you've actually isolated it and invested it, it's still your money at the end of the day. With typical insurance, the insurance company invests your premiums and keeps the profits to themselves. With self-insurance, you invest your premiums at 10% return and you keep the profit. Well, I like the sound of that. With typical insurance, years of not making a claim, the insurance company wins. With self-insurance, years of not making a claim, you still win, because at the end of the day, it's still your money. But if you're going to self-insure, there are some rules that you need to know about and follow. Firstly, you pay the same policy amount as an insurance company would charge you. They use actuarial science to calculate the risk. Use that. This is a great tip. If you plan to self-insure, it's impossible to calculate your own risk. I mean, how would you know? So you go into an insurance website, plug in your figures, get a quote, and then straight away, that's the premium you should pay yourself. Next rule, premiums must be totally isolated from your normal money. This is not your piggy bank. If you think to yourself, I need to upgrade my car. My old car's getting old, hence the name, and I'm going to get the money from my insurance pot and upgrade the car. No, this is especially for insurance. It is dedicated money. If you do not follow this rule, you will have hell to pay, and I will come and personally punish you. Oh, how are you going to punish me, Sebastian? I'm so scared. If you use your insurance money for anything other than insurance claims, I'm coming over to your house, I'm going to sit you down in front of the computer and make you watch YouTube ads back to back for 8 hours. No skipping. You better believe I'll do it. With self-insurance, even if you're between jobs, your insurance money is sacred and can never ever be used or touched for anything else besides genuine insurance claims. Think of it this way. You've lost your job and you've been out of work now 3-4 months. Can you go to your insurance company who you've been paying premiums to for 10 years and say, hey, give me some of that money back. I deserve it. How will your insurance company react? Yes, that's right. Insurance companies are Jabba the Hutt. The next self-insurance rule. Now, this is recommended, so it's optional for you. If you make a self-claim, then on the next quote, state that you've made a claim. You want to calculate your actual risk each time. It is that time of year again. You're about to pay your insurance premium to yourself. So you go to a website, any website of your choosing, and you pop in your information. They will ask you questions like, in the last 5 years, have you made a claim? If you've made a claim in the last 5 years on your own insurance, then you answer that yes, because you want it to calculate the risk, your genuine risk going forward. Or optionally, if you make a self-claim, that will have no effect on future premiums, right? So you got those choices. My recommendation is when you first start to build up your self-insurance pot, absolutely increase the premiums every time you make a claim, just like a real insurance company would. Later on, if you've got a great big fat pot with lots of money, well, you don't have to. The next rule is, this is recommended, which means you have an option. You pay yourself out any claim. No genuine claim is refused. No loophole is used against you. So this gives you peace of mind. You know for a fact that real insurance companies will always be looking for ways to reject your claim. They're always looking for loopholes. If you insure yourself, it'd be nice to know that's never going to happen to you. On the other hand, you could say to yourself, the premium that is calculated for me is based on the fact that there are restrictions, the fact that there are loopholes, and therefore you pay yourself out strictly by the policy terms of the policy that you got a quote on. Therefore, all excluded items apply. Right? The choice is yours. The next rule is, the more types of insurance you self-insure for, the better, as you spread your risks across an insurance pool. If you're self-insuring only for one type of insurance, that's fairly concentrated and there is a risk involved in that. But if you're self-insuring yourself for 5-6 different products and they're totally unrelated, the chance that you'll claim simultaneously on every single one of those policies is next to zero, right? The more policies you're self-insuring for and the greater the diversity, the safer you'll be. This sounds wonderful, Sebastian, but there is a flaw in your plan. Let's say I've paid myself one premium and then I have an accident and I need to claim and it doesn't cover my expenses. What do I do then? Right, here are a few extra rules. Start with cheaper items that you could cover in an emergency if you absolutely had to. This is really important. When you first start self-insuring, you start on your journey, do not self-insure for something that's going to cost you $200,000 that you may need to pay out. It's far, far too much, right? Start with small amounts and build your way up. For example, extended warranties on electrical items. You go to Harvey Norman and they say, oh, would you like an extended warranty? You say no, but if you're inclined to, then you go home, immediately put that same amount, the premium that they would have charged you, into your self-insurance fund. If something goes wrong, if my electrical shaver conks out, can I afford $500 to replace it? Well, in your insurance policy in the first year or two, no, probably you can't, but I've probably got $500 in the bank, and therefore if I had to, I could top up that amount. So if a claim is made on the fund and the fund can't cover it, which could happen in the first few years, you can cover the rest personally as a copay. Some other great starter examples, optional extras like windscreen damage on a car insurance. When you do a quote for your car, you'll get your basic car insurance, and then there's a whole lot of extras that you can tick. You can tick things like windscreen cover. You can tick things like if you have an accident or rental car, you get things like that. Typically, those optional extras are really overpriced. They're not particularly good value for money. But what you can do is you can split up your policy. You say, car insurer, you insure me for the basics. The optional extras, I'll look at the premiums, how much you're going to charge. I will pay for them myself, put that premium into my self-insurance fund, because I know if worse comes to worse, I can actually cover the amount. And in the long term, you'll always be saving money. So your real insurance covers the car, your self-insurance covers your windscreen. Another great example is your insurance excess. When you're doing an insurance quote, right at the end, there'll be a little slider where you put in how much excess you want. The greater the excess, the cheaper your insurance policy is. The good news about excesses is they're defined. It may be $3,000 or something, but it's defined. It's not unlimited. And probably you could pay that if you needed to. So what you do is you maximize the excess. You pay now that excess, say 20% of it per year, into your insurance fund. And therefore, if you have an accident, the bulk of the insurance costs will be covered by your car insurance policy. They'll say, now, give me $3,000 or $4,000. You say, aha, I've underinsured my excess. You go to your personal fund and it pays the excess for you. That's pretty clever. Let's move up to more advanced examples. Let's say you've been self-insuring now for a few years. You've got a bit of money in your insurance pot. This allows you now to start to self-insure for more expensive things. For example, dental insurance. Now, a filling may cost you $250, so even if you had to pay out $1,000 in a year, it's probably not going to ruin you. This could be ideal for self-insurance. Contents insurance. Contents insurance is fascinating because whenever you think of contents insurance, you always think of a flood. Incidentally, that's not normally covered. You'd have to pay extra for that, all right? So that's not normal. But you tend to think of a fire. Oh, everything in my house is going to be wiped out. Do you know how rare that is? Unless you live right on the fringe of the bush, it's actually fairly rare for your entire house to be wiped out. In fact, most people go through their entire lives and never make that sort of claim. What's way more likely is that somebody breaks into your house, grabs a few things, so money, your TV, maybe your PlayStation, things like that, and whisks them out, and they sell them on the black market because they're desperate for the cash. Well, if that happens, that may only be a couple $1,000s of items which have actually been taken from your house. So with contents insurance, the biggest chance by far is that it won't actually cost you very much, but yet you're paying for contents insurance as if your house is going to be wiped out many, many times over every decade. But that's not the reality. So, as a next level example, contents insurance can be great, but possibly avoid this if you're in a high risk area. So, my recommendations for self-insurance are start small and work your way up over time. The bigger your self-insurance pot, the more risk you can take on. If you have a run of bad luck and you're cleaned out totally, you've got no money left in your self-insurance fund, if necessary, you can always then take out traditional insurance policies and slowly work your way back up into self-insurance. This is all becoming so clear to me. I should take all my insurance policies and self-insure, right? Well, you could, but there's certain type of insurance policies that I'd probably recommend against. For example, car insurance. What happens if you hit a Porsche? Are you prepared for that? No, you're probably not. But you can always take a high excess on your insurance policy and self-insure for your excess. House insurance. No, you probably don't have enough money in the bank to cover the costs of that. So here are some great self-insurance options. Any insurance where the total payout is not that high. So some examples might be pet insurance, extras from your existing policies. You pay the actual real policy, but the extras, no, you self-insure for that. Extended warranties, which we discussed, dental insurance, possibly health insurance. It just depends. You may still want to use the public hospital system if you're going down that path until you get a bit more money. But certain things within the health system, yeah, you can certainly cover yourself. Possibly contents insurance, as long as you're not at risk of fire or anything major happening. Here's some great self-insurance options. Unemployment insurance. Here is how it works. You get your wage every 2 weeks or once a month. You put a percentage of that into your self-insurance fund and it grows over time. Now, if you become unemployed, what happens then? Say, after 3 or 4 months of being unemployed, then you can claim back on your self-insurance. This is great peace of mind. If you know that you've actually got a number of months worth of wages sitting there ready for you to claim on should you need it, that gives you amazing peace of mind. Possibly life insurance if you're healthy and you're not too old. The chance of you crossing over is fairly limited. So what is life insurance about? Let's say you have big debts outstanding like you haven't yet paid off your mortgage. What then happens if you actually do cross over? Who's going to pay for that if, for example, your wife or your partner is at home with the kids and can't work? Well, that's where life insurance comes. So if you actually are self-insuring, so you're socketing money away at the normal rate of life insurance, probability is you'll never ever use it. But if you do, then you know that you've got a massive nest egg that you can draw on if you need to. Okay, this is making sense to me, but why put in the share market? Is the share market not too risky? And I never know when I'm going to claim on my insurance, right? What happens if the share market has crashed? That is a problem for me. Insurance is a long-term commitment. You may not actually claim on something your entire life, let's face it, or you may not claim for decade after decade. This is long-term, and therefore that money should never be sitting in your bank. It needs to be invested in the stock market where it can grow at, say, 10% year after year and compound up. But what happens if the share market drops by, say, 30, 40%? Well, if you've been growing your money for a decade, you'll actually already be so far beyond that point that if the share market does drop by 30, 40%, it doesn't matter. You're well ahead of your cash amount if you stuck it in the bank anyway. Importantly, let's say that you're self-insuring against multiple different types of policies. Therefore, if you need to claim, then you're only actually claiming on a portion of that, and all the other 4 or 5 policies that you've got that you're self-insuring for lives on. So you're not actually taking out all the money, you're only taking out a small portion of it, and it will survive quite nicely. Is there anybody whose self-insurance is not advisable for? Well, yes, there is. You should not self-insure if you're not comfortable with it. This is an option for you to consider. This is not financial advice. So, some takeaway tips. Start small and work your way up. Within the first few years, you may not have that much socketed away in your insurance fund, so make sure you're not covering amounts that are too high. Your self-insurance pot is sacred. Do not touch that unless you're doing a genuine insurance claim. The more diverse the insurance you self-insure for, the safer the overall pot will be. Be comforted by the knowledge that your claim will never be rejected. And this is such an amazing thing. Not only are you not wasting money, right, because there's no fees, you get to keep all the money at the end of the day, the fact that you'll never ever be rejected on your insurance claim is just priceless. So, does Sebastian St. James self-insure? Yes, he does. I've been self-insuring for most of my life, so this is not a new idea to me by any stretch. There are a few things I do actually pay real-world insurance for, but an awful lot I self-insure. Am I the only person in the world that actually self-insures? Apparently not. In a previous video, one of my viewers said, "How on earth did you find the first photo of me?" This is the photo that Trade Tech thinks he looks like. What do we think, viewers? Is that likely? I have very little insurance for this reason. They effectively run casinos. They know the odds of all the claims and rigged the policy full of loopholes against you. So I created my own investment insurance fund. That way, if I never have to use it, it remains my money. Do people who self-insure actually go to annual conferences and have a secret handshake? No, they don't. But I think we should start one. Let's say I've been self-insuring now for a few decades and my pot is getting rather large. What do I do with it at the end? Well, if you've reached that level of comfort, you could start to give yourself a loyalty bonus. Like when you've been with a car insurer for 5 years or more, they say, "Oh, we'll give you 5%, 10% off." You could start to reduce your premiums over time, if that makes sense. Once you're old, let's say that you're retired and you're no longer working. Hence the term retired, I guess. And in the past, you've been collecting premiums to pay out for unemployment insurance. That will never happen now. I no longer work. So you could take out those premiums, start to pay them back to yourself as a type of mini pension over time, right? If you're married, hopefully happily married, and you're getting on in years and your chance of crossing over actually is increasing, make sure that your insurance fund is actually in both of your names so that if you do, in fact, go away, then your surviving spouse has direct access to all that money. Only for insurance again. Remember, it is not a piggy bank. Throughout this video, I've made some claims about how insurance companies waste money and what the potential risks are. Where do I get all these figures from? Where is my proof? That I actually did in video part 1. I know this is part 2, so go ahead and click on the video now and find out.